It sounds impossible. After all, dealerships have giant showrooms, acres of inventory, hundreds of employees, and millions of dollars worth of vehicles sitting on the lot. You'd think selling cars is where all the profits come from, but here's what most people don't realize. For many dealerships, the car itself isn't the business. In fact, some dealerships make surprisingly little profit or even lose money on brand new vehicles. So why are investors still buying dealerships for tens or even hundreds of millions of dollars?
Because the real money comes from places customers rarely think about. Today, we're breaking down the economics of owning a car dealership, revealing how dealerships actually make money, why some owners become incredibly wealthy, where the risks hide, and why this business remains one of America's largest retail industries. At first glance, owning a car dealership looks straightforward. Buy cars from the manufacturer, sell them to customers, keep the difference. Simple. Except that's almost never how it works.
A modern American dealership is far more like a financial services company, mixed with a repair shop, an insurance broker, and a retail business, all operating under one roof. Selling vehicles is only one piece of a much larger economic machine. To understand why, we first need to understand how dealerships get their inventory. Unlike most retailers, dealerships don't simply order products and pay cash. Instead, most vehicles are financed through what's known as floor plan financing. Think of it like a giant revolving line of credit. When a manufacturer ships a new vehicle to the dealership, the dealer usually doesn't write a check for the entire amount. Instead, a specialized lender finances the inventory. The dealership begins paying interest while that vehicle sits on the lot. That means every day a car remains unsold, it becomes slightly more expensive. Suddenly, those rows of shiny vehicles aren't just inventory, they're carrying costs. A dealership with 400 new vehicles can easily have tens of millions of dollars tied up in inventory. If sales slow down, financing costs continue growing. That's one reason dealerships are so motivated to sell vehicles quickly. But here's the surprise. The profit margin on a new car is often much smaller than most buyers imagine. Depending on the brand, competition, incentives, and local market conditions, the gross profit on a new vehicle may only represent a small percentage of its selling price. Sometimes dealerships even sell certain vehicles at extremely small margins simply to meet manufacturer sales targets or qualify for performance bonuses. Those bonuses can become incredibly important. Manufacturers often reward dealerships that hit monthly, quarterly, or annual sales goals. Selling one more vehicle at the end of the month could unlock a much larger bonus across dozens or even hundreds of vehicles. That's why customers sometimes find unusually aggressive discounts during the final days of a sales period. The dealership may not be chasing profit on that single sale. It may be chasing a much larger incentive. But if new cars don't generate massive profits, where does the money actually come from? The answer begins with used vehicles. Unlike new cars, dealerships have much greater control over pricing. They purchase vehicles through trade-ins, auctions, lease returns, and direct purchases from consumers. If a dealership acquires inventory wisely, reconditions it efficiently, and prices it correctly, used vehicles can generate significantly stronger margins than many new cars. Every trade-in creates another opportunity. The dealership earns money selling the customer's new vehicle. Then it prepares the trade-in for resale. Now the same transaction can produce revenue twice. That's one reason salespeople often encourage customers to trade in their existing vehicles. But even used cars aren't the dealership's biggest profit center. The real money often arrives after you've already agreed to buy the car. Welcome to the Finance and Insurance Department, commonly called the F&I office. This small office can generate thousands of dollars in additional profit from a single customer. Here, buyers arrange financing, extended warranties, maintenance plans, gap coverage, tire protection, wheel protection, prepaid service contracts, and various insurance-related products. Many customers focus intensely on negotiating the vehicle's purchase price, while paying far less attention to financing terms. a lower monthly payment can feel attractive, even if the total amount paid over the life of the loan increases substantially. For dealerships, financing itself can become another revenue stream. When a lender approves a customer's loan, the dealership may receive compensation for arranging the financing, depending on the lending agreement and applicable regulations. Suddenly, selling the vehicle was only the beginning. The financial products attached to the sale can become equally valuable. But perhaps the most overlooked part of the dealership business sits behind the showroom, the service department. Many dealership owners will tell you the service department is the engine that keeps the entire business running. Every oil change, every brake replacement, every tire installation, every transmission repair, every factory recall, every scheduled maintenance visit. Each one creates recurring revenue long after the original vehicle sale has ended. Unlike vehicle sales, which fluctuate with interest rates and consumer confidence, maintenance remains relatively consistent because cars eventually need repairs regardless of the economy. A customer who bought a vehicle 5 years ago may continue visiting the same dealership for maintenance every year afterward.
Some dealerships service thousands of vehicles every month. Those repair orders generate labor revenue, part sales, diagnostic fees, and ongoing customer relationships. Then come replacement parts. Dealerships don't simply install components, they also sell them. Original equipment manufacturer parts often carry attractive margins and support both retail customers and independent repair shops. Even collision repair centers frequently purchase parts through dealership parts departments.
Now the dealership has another recurring business. Then there are fleet accounts. Commercial businesses, rental companies, government agencies, police departments, and construction firms often purchase multiple vehicles at once while returning regularly for maintenance and repairs. These long-term relationships create predictable revenue beyond individual consumers. Of course, operating a dealership isn't cheap. Land alone can cost millions of dollars, especially near major metropolitan areas. Manufacturers frequently require expensive facility upgrades to maintain franchise agreements. Modern showrooms, service bays, customer lounges, specialized diagnostic equipment, charging infrastructure for electric vehicles, and technician training all require substantial investment. Labor costs continue rising. Highly skilled technicians are increasingly difficult to recruit. Technology grows more complex every year. Inventory financing becomes more expensive when interest rates increase. Insurance premiums continue climbing. Advertising budgets remain enormous because every competing dealership wants the same local customers. Digital marketing, television commercials, sponsorships, search advertising, and customer acquisition campaigns can consume significant portions of annual budgets. Then there's another challenge many customers never see: depreciation. New vehicles begin losing value almost immediately. If demand suddenly weakens or manufacturers reduce prices, inventory already sitting on dealership lots may become harder to sell profitably. Recent years demonstrated exactly how quickly market conditions can change. Periods of limited inventory allowed many dealerships to sell vehicles near or above sticker price. As production recovered and supply increased, pricing power shifted again, forcing dealerships to compete more aggressively. Successful owners constantly adapt. They're not simply selling cars, they're managing inventory, financing costs, labor, customer relationships, manufacturer requirements, service operations, technology investments, and changing consumer demand, all at the same time. That's why owning a dealership requires far more business expertise than many people realize. So how valuable can one dealership become? Consider a hypothetical example. Suppose a dealership sells 1/500 new vehicles and 1/200 used vehicles each year. Add financing income, service revenue, part sales, warranty work, commercial fleet business. After covering payroll, inventory financing, property costs, advertising, taxes, and operating expenses, the dealership generates several $1 million in annual operating profit. Businesses with consistent earnings can command substantial valuations, especially if they represent strong brands in growing markets. Large dealership groups have expanded by acquiring smaller operators, building regional networks that benefit from shared purchasing power, centralized administration, and stronger negotiating positions. Economies of scale become increasingly valuable. Yet despite all the complexity, the biggest misconception remains surprisingly simple. People think dealerships sell cars. In reality, they sell relationships. A customer might purchase one vehicle every 6 or 7 years, but over that time they may finance the loan, buy accessories, purchase warranties, return for dozens of maintenance visits, replace tires, repair collision damage, trade in the vehicle, and purchase another one. The lifetime value of that customer can far exceed the profit from the original sale. That's the economic engine hiding beneath every dealership. The next time you drive past rows of sparkling new vehicles, don't just see cars waiting for buyers. See millions of dollars in financed inventory, a sophisticated financial operation, a high-volume repair business, a parts distribution center, an insurance marketplace, and a customer relationship business designed to generate recurring revenue long after the keys are handed over. Because in the end, the smartest dealership owners were never just selling automobiles. They were building a business where every vehicle sold could create years of future income. And that's the hidden economics of owning a car dealership. If you enjoyed uncovering the business behind businesses, consider subscribing, because sometimes the most ordinary companies hide the most extraordinary economics.